transferring opening balances to new accounting software. Switching to a new accounting software program is a common occurrence for businesses. One crucial step in this transition is transferring the opening balances from the old software to the new one. These balances represent the company's financial position at the start of the new accounting period. Accurately transferring these balances ensures a smooth and accurate transition. The new accounting software will utilize these balances to track financial activity during the latest period. If the balances are not transferred correctly, it could lead to inconsistencies in reporting and financial analysis. What is the balance sheet financial snapshot? The balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It shows what a company owns, assets, owes, liabilities, and the value of the owner's investment, equity, fundamental equation. The balance sheet is based on the fundamental accounting equation, assets equals liabilities plus equity. This equation highlights the relationship between a company's resources, obligations, and ownership. Key balance sheet accounts. Assets. Assets represent resources owned by the company. They can be tangible, like property, or intangible, like patents. Common asset accounts include cash, accounts receivable, inventory, and equipment. Liabilities. Liabilities are obligations owed to others. They represent money the company owes to creditors. Examples include accounts payable, salaries payable, and loans payable. Equity. Equity represents the owner's stake in the company. It's the difference between assets and liabilities. Key equity accounts include common stock, retained earnings, and dividends. Assets, liabilities, and equity. The balance sheet is a fundamental financial statement that shows the financial position of a business at a specific point in time. It comprises three primary components: assets, liabilities, and equity. Assets represent the resources owned by the business, such as cash, inventory, and equipment. Liabilities are the obligations the business owes to others, like loans and accounts payable. Equity represents the owner's stake in the business, reflecting their investment and retained earnings. Determining the opening balance. The opening balance represents the financial position of a business at the beginning of an accounting period. It is crucial to accurately determine this balance before starting a new accounting period. The opening balance serves as the foundation for all subsequent transactions and financial statements. Identify the starting date, the date on which the new accounting period begins. Review prior period's balance sheet, the last balance sheet of the previous period. Adjust for any changes. Consider adjustments for new transactions or changes. The starting date of the new accounting period is the first step in determining the opening balance. The final balance sheet from the previous period is a vital source for gathering information. It's essential to review any adjustments that may have occurred since the last balance sheet, such as new transactions or changes in accounting policies, to ensure an accurate opening balance. Gathering the necessary information. Gather existing balance sheet. Begin by obtaining a copy of the most recent balance sheet from the old accounting software. This document provides a snapshot of your company's financial position at a specific point in time. Ensure the balance sheet is accurate and reflects all transactions up to the date you wish to transfer. Identify key accounts. Review the balance sheet and note the key accounts with their corresponding opening balances. The main accounts to consider include assets, liabilities, and equity. Identify the balances for each account category, ensuring you have all the necessary information to accurately transfer the opening balances. Collect supporting documents. In addition to the balance sheet, gather any supporting documentation for the opening balances. This could include invoices, bank statements, or other relevant records that provide evidence of the account balances. This documentation is crucial for verifying the accuracy of the opening balances and ensuring a smooth transition to the new software. Reviewing the balance sheet for accuracy. Verify account balances. Ensure all account balances match source documents. Compare numbers to previous periods. Check for errors or omissions. Look for any discrepancies or missing entries. Scrutinize transactions for accuracy. Confirm account classifications. Ensure assets, liabilities, and equity are appropriately categorized. Reconcile with supporting documentation. Compare balance sheet figures with bank statements, invoices, and other records. Thoroughly reviewing the balance sheet for accuracy is crucial before transferring the opening balances to a new accounting software program. This ensures data integrity and prevents potential errors in the new system. It also helps to identify any discrepancies or omissions that need to be addressed before proceeding with the transfer. Preparing the opening balance journal entries, identify accounts. The first step is to identify the specific accounts from the balance sheet that need to be transferred. These accounts typically include assets, liabilities, and equity. Make sure to list each account separately for accurate recording. Determine debit and credit. For each account, you need to determine whether it has a debit or credit balance. This is essential for creating accurate journal entries. Remember that assets and expenses have a debit balance, while liabilities, equity, and revenue have a credit balance. Create journal entries. The next step involves creating journal entries for each identified account. This requires documenting the account name, the debit or credit amount, and the date. You can use a spreadsheet or accounting software for this purpose. Review and verify. After creating the journal entries, it's crucial to review and verify their accuracy. Make sure that the total debits equal the total credits in each entry. This step ensures that the accounting equation, assets equals liabilities plus equity, remains balanced. Entering the opening balances in the new software. Once you have prepared the opening balance journal entries, the next step is to enter these balances into the new accounting software. This process involves carefully transferring the balances from your previous software or records into the corresponding accounts within the new system. Different accounting software programs may have slightly different account structures and entry methods. It's essential to familiarize yourself with the specific requirements and procedures of the new software before proceeding. This will help ensure that you enter the balances accurately and in the correct format. Navigate to the chart of accounts. Locate the appropriate accounts for each balance. Enter the opening balances. Input the amounts into the corresponding account fields. Review and verify. Double-check all entries for accuracy. Verifying the transferred balances, compare balances. After transferring the opening balances, it's crucial to verify their accuracy. Compare the balances in the new accounting software with the original balance sheet. Ensure all accounts and their corresponding values match exactly. Reconcile discrepancies. If discrepancies exist, carefully investigate the source. Check the original balance sheet for errors or omissions. Ensure all transactions were properly recorded in the old system and correctly transferred to the new one. Document adjustments. Any necessary adjustments to the balances should be documented. Create a record of the changes, including the account affected, the original balance, the adjusted balance, and the reason for the adjustment. Reconciling any discrepancies. If discrepancies are found between the old and new software, carefully review the records in both systems. Reconciliation requires a close examination of the accounts and entries to ensure accuracy. After identifying the discrepancies, determine the cause and make the necessary adjustments. This may involve correcting errors, updating data, or revising entries to ensure consistency between the two systems. Document all adjustments and changes made during the reconciliation process. This documentation will be helpful for future reference and auditing purposes. It will provide a clear history of any changes made to the balance sheet data. Best practices for a smooth transfer. Thorough planning. Carefully plan the transfer process. This includes identifying the specific accounts you need to move and the exact information that needs to be transferred for each account. It is also important to establish a timeline and schedule for the transfer process. Data backup. Before you start transferring data, make sure you have a backup of your current accounting software data. This will help you recover any data if there are any errors during the transfer process. You can also use the backup to compare data between the two software programs. Importance of maintaining accurate records. Financial reporting. Accurate records are crucial for creating reliable financial statements, which are vital for decision-making, tax filing, and investor relations. They allow for proper tracking of income, expenses, and assets, ensuring transparency and accountability. Business insights. Maintaining accurate records provides valuable insights into business performance, identifying areas for improvement and growth. By analyzing financial data, you can identify trends, optimize operations, and make informed decisions. Regulatory compliance. Accurate records ensure compliance with various accounting regulations, tax laws, and industry standards. This minimizes legal risks and protects your business from penalties and fines. Auditing and verification. Accurate records facilitate smooth audits and verification by external parties. They provide evidence of transactions and financial positions, strengthening the credibility and reliability of your business. Ongoing monitoring and adjustments. Regular reconciliation. Regularly reconcile the balances in the new accounting software with the original balance sheet. This ensures consistency and helps identify any discrepancies that may have occurred during the transfer process. Data entry errors. Be vigilant about data entry errors, which can happen in any accounting software. Regularly review your data for accuracy to prevent errors from accumulating and leading to incorrect financial reports. Account updates. Keep track of changes in your business operations. If you add new assets, incur new liabilities, or modify existing accounts, update your accounting software accordingly to maintain accurate records.